How about the 15th order at 3 p.m.? Let's stop for communication if anybody has any. Okay.
There's nothing.
Well, we all introduce ourselves. Yeah, good. Mr. down there.
I'm Michael Freeman. I'm a citizen of Groton since the 70s, and I was supposed to be retired this year, so I was going to help the town out because I've been heavily involved in Stonington as a teacher and union president, but I've also been involved in investing with the State Investment Advisory Council for about a decade. So this was my retirement fund job. I'm not retired.
Great to have you.
My name is John Burbank, and my parents have had a house in Groton since the 1980s. My wife and I built a house here about 15 years ago. We moved into full-time about 4 years ago. And today I do various types of board work. I'm on the board of the Connecticut Public Television, Public Radio. Then I'm on a few corporate boards around the country. And I'm delighted to see if I can help out here in Groton.
Great. Mark Alfinger, been on the board for a while.
John Burt, town manager. Anybody on the Zoom?
Yeah, I'll go. This is Jason Pollard. I've been on the board probably for 2 years, I think. I'm a firefighter in town for Paquonic Bridge, and I also own a couple different businesses on the side.
Ken Hine from Sageview, and we are the investment advisor working with the town of Groton's pension plan. Been with Sageview and with Groton for about the last 4 years. My predecessor, Tim Burns, was a longtime servant of working with the town. With me as well is a couple of Marks. Mark Foster, who's been with us. Kind of handles the non-investment end of the advisory, and Mark Forkey, who's new to this, as this fortunately or unfortunately is going to be my last meeting as I'm actually retiring and at the end of this year. So it's with a little bittersweetness that I say that because it's been great working with you guys, but time to enjoy my grandkids and maybe spend a little bit more time down at the Connecticut shoreline as well. So I'll let thank you. I'll let Mark Forkey kind of introduce himself. Thanks, John.
Thanks, Ken. My name is Mark Forkey. I'm Senior Investment Advisor at Sageview and happy to meet you all. I've been with Sageview for 14 years and been in the industry just about 30 years coming up this month. So some big shoes to fill with filling in for Ken, but we'll work hard for you guys.
Thanks. Mark Foster, just a quick introduction.
Yeah, hi everybody. Again, Mark Foster with Sageview, been here for going on 11 years. Started my career at Putnam Investments in the mid 90s and have had a retirement problem ever since. It's been great getting to know you all and getting to work with you, and we'll continue to work with Ken and Mark through the end of the year, and then Mark and I will be seeing everybody after during the first quarter of 23.
My name is
Pat Blizzard. I'm sorry. Okay.
No, go ahead.
Okay. My name is Pat Blizzard. I'm with SEI Investments. We're the investment manager. We work in conjunction with Sageview to advise your plan, come up with various asset allocation strategies and so forth. And I've been with SEI for my entire career, so 26 years at SEI Investments.
Great. Our heads cut off on the video of the room. It looks like it to me. Can you see all of us? It's cut off.
Your heads are cut off.
Easier to adjust the camera than for us to overhead.
Sit on the floor.
Yeah.
That's great, John. That works right there.
Okay. That's on the agenda. There's a report from our finance director, and she was not able to. She show. There she is. We'll promote her, the finance director. B, are you there?
You're muted.
Yep, sorry about that. How is everyone?
Good.
Sorry, I'm a little late.
No problem. Can you hit the highlights of your quarterly report?
Yes, so for the quarter ending September 30th, 2022, expenditures are approximately 2.8 million. The majority of this amount is relating to the monthly pension payments and the return of contributions for 5 employees during this time. Revenues exceeded expenditures at this time of the year, pretty much due to the fact that the total annual employer contributions are typically made in the beginning of the fiscal year, usually around September. And that's only offset by 3 months of pension payments to date. I did want to note that revenues are typically higher at this time of the year when compared to prior years. But due to the fluctuations in the markets, a realized loss of approximately 2.5 million has offset the employer and employee contributions, as well as the investment income earned.
Any questions for D?
So new person question. I looked through some of these materials earlier today, and I was just trying to figure out, you as an outsider, you sometimes hear about unfunded pension liabilities. And I don't have a sense from looking at any of the materials today. Is that a problem for us?
It has been, no, and it's, it's not quite as been in this last half year, I'm sure, but we were somewhere in the ballpark of 85% funded.
Okay.
And we have a 7% assumption rate. I think it was 7 last year, right? So we'll be talking about whether to change it. Of course, the more it changes, the more the town pays. So there's striking balance, but wanting to keep it good and whole. Yeah. So yeah, I think it's always been pretty good, hasn't it?
There for a long time, it was overfunded. But it's been in that 80-85% for quite a while.
And when is there a time of the year that we look at that metric, and then other times of the year? Because it's, and you guys know it off the top of your head, is that something that?
Well, in terms of the assumption rate, or in terms of
just the I guess the amount of the liability that's funded. How do we? I would imagine one of the key jobs of this board is to ensure that there's no trouble in regard to that.
Right, and that's what we have our advisors. That
And
goes
I was
everything.
just looking at it, like I didn't see that metric in these materials.
I think, don't we still kind of have an actuarial?
Yeah, I was going to shoot that to everybody. Yeah.
February.
Once a year.
February, maybe John can shoot you last.
I'll shoot to the last
I
one.
just
Yeah,
want to make sure that
Yeah,
I
Great
understand.
question.
I will get that up to everybody.
That is, this is Ken, that is like more of an actuarial question as it relates to the liabilities. Obviously, how the assets and the liabilities work together is something that both SCI and Sageview pay very close attention to. But I believe, John, it's the second quarter that we have the actuary actually come in and present the actuarial
In your
report.
report, you're just reading out on the performance of the funds and the investment allocations and things like that, as opposed to bouncing that up against the liability and understanding where we stand.
Correct, and we really take an annual look at that liability number, and obviously today, as these markets are extremely volatile, the impact of the assets.
It's better at the end of the day today than it did in the beginning of the day.
Yeah, exactly. Today's a good day. So, yeah.
Okay. Good, thank you.
Okay.
Next up, approval of the June 1st, 2022 minutes and the August 11th, 22 minutes.
So move.
O'Connor moves. Do we have a second?
Jason, I'll second it.
I don't know if there's any harm with Johnny, whether here, but I don't see any harm in second. Or make, we'll hit in a second.
Yeah, my understanding is even if you're not at the meeting, you can second thing, or you can make the motion to approve and second, as long as you've read the minutes.
Yeah. Okay, we have a first and a second. Any discussions? If not, all in favor, say aye.
I
Opposed? Opposed, same sign.
Abstained since it wasn't part of the process.
Okay. We have
John?
Michael Freeman. What?
Oh, it's Arnisha. Can you hear me okay?
Yeah.
Okay, the connection on my end is a little rough, so I just wanted to make sure you were taking notes of who did the first and second for when our office does the minutes, because I couldn't quite make it out. And just when we watch the recording back, we may not be able to tell that.
Okay, yeah. I'll
Thank
do that.
you.
Okay, we have a first and a second, and all aye except for one abstention with Freeman. On to authorization of payments. You know, we always do these as a block unless there's some issue with one.
The operations of payment, so I understand what that is that.
I think start getting their pension.
These are two.
Yeah, they retired, yeah. Yeah.
Make sure that I see.
Yeah.
I'll move both Janet and James authorization of payment. This is Mark making the motion.
Second, Michael Freeman.
Okay, we have a first and a second. Any discussion? If not, all in favor, say aye.
Aye.
Aye. Opposed, same sign. Motion carries unanimously.
Just one quick question, even though it's after the phone, the mention that appeared for Betty that deferred. Does that mean?
They've left or vested, but they haven't retired. Isn't that what it is, Marco?
They may not be of age yet.
Yeah.
Or they're holding off. You're looking at previous minutes.
Oh, okay, all
Yeah,
right.
that's,
Oh,
I
that's
think
the
we
minutes
did
from
that
last time.
last.
Oh, I
Yeah,
see.
yeah.
But that's what, they may not be of retirement age or,
Right.
well, they're probably not of retirement.
Right.
Okay.
Okay. On to SCI's report.
Great, thank you. Let's pull it up here. Okay, great. Thanks for having me today, and it's good to meet all the new folks. I'm looking forward to working with you. As I mentioned, I work at SEI Investments. Been there for quite some time. Been working with the town of Groton for a couple of years now, and essentially what SEI does is we're a manager of managers, right? So we'll show you various funds, but within those funds, there's multiple manager lineups for the active strategies, and obviously you have some passive in your portfolio as well. So John Wade also could not make this meeting today, unfortunately, but he also works with me, and he's kind of our chief actuary at SEI. And the reason we have him on the advice team is really to look into those numbers that we were discussing earlier, the assets, the liabilities, how that all works together. You know, what's kind of that net hurdle rate in order to keep the fund moving upward trajectory as far as funding status, and looking at all the cash flows and everything else, all the demographics. So that's an important part of what we do. And then we work with SageView as well throughout that process. So what I'm showing here on page 3, and the reason I brought that up is you can see that we did an asset allocation study about 3 months ago, and we changed the portfolio mix. So you could see what the prior mix was and where we are as of today. That was about the change happened about a month and a half ago. So again, we further diversified the portfolio. We shortened duration a little bit, and we added a little bit more into international. We've been underweight significantly international. So we took advantage of that market lagging for a long time now, and just bumped up that allocation slightly to take advantage of some of the valuations we're seeing there. So kind of just a general overview of what we did. There's also some notes here on this page, but I'll speak through all this as we move forward. If anyone has any questions throughout, please just stop me and I'll try to answer your questions. I'm going to put this as
the general allocation between equity and fixed income is that just sort of an industry standard for municipalities, or is it adjusted for anything specifically?
So a lot of factors go into play with that. So for one, if you have a pretty severely underfunded plan, we're probably going to have a little bit more of an aggressive allocation. I'm sorry, not even underfunded, but also, some plans still have 7.5% actual assumption rates, right? So a 7.5 is going to look more aggressive than what you're seeing here when we had a 7 last year, with discussions to possibly even lower that further. So that's part of the equation. It's never the same mix for this. All my plans have different, slightly different mixes. Some of it has to do with the risk tolerance of the board themselves, and how much volatility they're willing to take on. So there's a lot of factors that go into it.
If you had to look at this allocation, we would be on the more conservative side because we're relatively well funded.
Yes, yeah, this is a more conservative allocation.
Yeah, I'm not sure I would 100% agree with that. I think it's, a 60-40 mix if you throw real estate kind of into that equity mode, and it's kind of a separate animal in and of itself. But, having a, larger equity exposure, tends to be a little bit, maybe a little bit on I would say on the riskier side based on where we see plans going these days. But it's not, it's not extreme, certainly at either end. And I think it's certainly within industry norms, in terms of what other, municipal or pension, public pension plans are doing.
Yeah, I'd agree with that, Ken. And I think the big factor is, you've reduced your actuarial assumption rate over time, and that's allowed us to be slightly more, a little bit slightly more defensive. But you still have a very well put together portfolio. Like Ken said, it's almost a 60-40 if you look at the real estate. So,
from a process standpoint, do we look at the allocation once a year? Is that what we're going to do?
I mean, we're certainly looking at that,
I know we look at it constantly, but we set it once a year. Is that
We review it, yeah.
It may be a little bit longer.
We're a little late now, though.
Yep.
Go ahead.
I mean, clearly the actuary is looking to have an expected return, either the confirmation of where we are, or do we think about changing it? I would say probably every couple of years we take a real deep dive into that expected return. I'll go into that a little bit in more detail, after we kind of go through the review of the portfolio. But it's difficult when you get crazy markets like this, where it's tough to judge what the expected return of an individual asset class will be short term and even longer term. And so we sort of, look at it and say, is it reasonable? And then, once the markets kind of calm down a little bit, what's the industry take in terms of the expected returns for the individual asset classes, and then how do we come up with that expected return for the for the overall portfolio? Just a little bit of history. We've gone from a 7.5% return probably 5-6 years ago to 7.25%, and then relatively recently, within the last year and a half, we dropped it down to 7%. So there is changes that do happen, and again, all of this was is not an outlier at all to what we see in the industry. More to follow on that, by the way. So
Yeah, this is my. Go ahead. I'm sorry, Ken.
No, I was just going to add one more thing, in that one of the reasons that we made some changes last quarter was to add some diversification within the asset classes. And so we added a limited duration section to the overall fixed income portfolio, and then some other small cap, mid cap, and factor based portfolios within the equity sector. So trying to diversify again within the overall equity asset classes and fixed income asset classes, hopes to reduce that level of volatility overall, while trying to get close to that expected return that we're looking for, maybe hopefully a little bit above that. Sorry, Mark.
Yep, that's okay. I was going to mention, I think COVID to some degree has tripped us up a little bit in terms of our cadence, because we were pretty regularly reviewing things on an annual to 15-month basis, starting with really the investment policy, just tweaking it a little bit. And with 2 new members, it may be good if we plan something in the first or second quarter of next year, a couple-hour workshop.
That'd be great.
In person,
Then I can get all my annoying questions out of the way.
Yeah. Because I think that's been very helpful over the years. And on the other hand, given how the market's been all over the place, you know, we certainly, our tradition has not been to try to, you know, figure out the market as we're going forward here. And the mix that we have had over the years, I think has served us very well. But we're always looking to compare ourselves to what are other clients doing and how are they doing and so forth. You know, putting investments in cash over the last since 2008 hasn't been, you know, very helpful at all. But so maybe that's something we can think about.
I think that makes a lot of sense. I know Mark Forkey will kind of be going over some of the items that we look at when we evaluate the investments that SCI is doing. So we'll go over that today. But I think, you know, setting up and making sure that we cover, you know, both the asset allocation study, what that's all about, how we do that. I'll cover a little bit of that today, but I think a special meeting on that and certainly reviewing the investment policy statement would be helpful, you know, for everybody, but particularly for, you know, for the new members. So
I'd even go so far as to say that I know so little. I don't even know the sources of funding. Is this all coming from, you know, what percentage is coming from employee contributions versus taxes, or I don't even know what the sources of funding are. And
It's a mix.
Yeah.
so it'd be, I guess, yeah. I don't even know if we would have a target for that. Do we want it to be more employee or tax based? I don't, you know, that kind of bottoms up.
Yeah, and the employee is a long process to change that at all with union contracts,
Yeah,
yes. So, yeah.
Sure,
Yeah.
yeah, and that's fair. And we all need, the rest of us
Yeah.
need a reminder.
Yeah.
So,
At your last meeting, however, looking at the losses, being in the top decile was impressive. When we hit the recession at the state, we were in the top quartile and celebrating. And that was a loss of billions of dollars, but we were conservative in most of the portfolio, and having gone through your numbers, you're well placed. And the conversation about starting the US equity factor made a lot of sense because it'll give you a little bit more nimble, because there's no way to time this market. Like, I'd stay out of tech, and unemployment is going to go up. But trying to time it, if I could do that, I'd be a billionaire. So not in the game of timing, but looking at 85% funding compared to the state's funding ratio doesn't scare me, but I'd like to see it get better. But it's going to be hard to do that for the next year or two. We're not going to recover from these losses overnight. So as long as we stick with the fundamentals that I've read, I watched a couple of the past meetings, are sound. So I don't think anybody's trying to go too crazy here. Like I can't stand emerging markets, and I'm a little afraid of real estate from past experience. But how about crypto? Not unless we want to hire somebody. But anyway, the fundamentals that I heard in last meeting were quite sound as to the reallocation of what was occurring. So everybody's, you know, I know enough to say we just got to keep our head on our shoulders. What goes down will go up, and there's no way that anybody's going to time it perfectly. Although you did a nice job explaining timing the market in the last meeting, but you know that's the difference between a millionaire and a billionaire.
You know, we spend a lot of time, both SCI and Sageview, and certainly working with our clients to try to understand and get the allocation right conceptually, right? So that, you know, how do the different asset classes work with each other historically, and, you know, how can we make 1 + 1 = 3 by, you know, getting a reasonable return, but lowering the overall volatility of that total return. So conceptually, we always, you know, want to make sure that we get that right. And then the question is, you know, how do we actually implement it? You know, and you know, what is SCI doing within the context of managing those assets within the allocations that they're making? And that's a big part of what, you know, Sageview does, is to sort of look at it and say, you know, is SCI who's managing the money doing their job. And so we'll give you that guidance as well. So kind of the big picture, is the allocation appropriate? Is it reasonable? And then, kind of on the detail perspective, are they actually performing well, as well. So those are really kind of the two big pictures that we're looking at, the conceptual overall, kind of the big picture, and then the little picture, how they actually performing. So Pat, sorry, man, I'm eating up your time here. So
That's okay.
my
No,
bad.
that's good. That's good.
Okay.
No, I mean, that's a great strategy, because, SageView, that's an extra level of fiduciary protection for the board members. So it's set up the right way. Any other questions before I move on here?
Oh, go ahead.
Okay, so I'll go through these front 4 slides relatively quickly. I know SageView will probably have some perspectives on the market as well, so won't spend a whole lot of time here. Obviously, we've had extreme volatility. It's been one of those scenarios where, unfortunately, people who are 62 to 64 years old, getting close to retirement, thought they had a very safe nest egg loaded up in fixed income safe strategies, which they believed. That was not the case. Everyone lost money. It didn't matter if you're in equities or fixed income. It didn't matter whether you were in large caps or small caps or US and international. You can see on the right-hand chart here, the 1-year bar as of 9/30, extreme negative numbers across the board. We haven't seen a scenario like this since the credit crisis back in 2008. And actually COVID early in 2020, we had a brief spurt of negative activity like this as well. So the longer duration you had, the worse you did. You can see long duration bonds were down about 27%. Your US investment grade bonds were still down in correction territory. They were down just around 15%. Asset classes like high yield and EMD underperformed as well. They did add some diversification benefits because they didn't underperform as much as some of the other more equity-like asset classes. And the big winner really was commodities. And we all know that story, obviously. We're seeing that in the grocery stores. We're seeing that at the gas pump every day. So again, very negative scenario. I'm kind of moving forward to where we are today. October was a better month. And today's a very, very good day. And I hope it stays that way. So it's a perfect example of market timing. Imagine if you were so tired of the market volatility, you got out of the market yesterday and missed today. It would have been very extreme. You would have lost out on a lot of money. So today's a perfect example of that. As far as US equity markets, we've talked about the last several meetings. There was a big growth trend with the FANG stocks leading the way, specifically in 2000 and last year. We've seen a divergence away from that. So when you look on a 1-year basis, you could see that value is down about 11.4%, where growth is down 22.6%. So it has added some diversification benefits. And even looking at it from a sector standpoint, we're seeing new leadership here. So on the left-hand side are the top performers for the quarter. The right-hand side are the worst performers. And you're seeing areas like consumer discretionaries, energy, financials, industrials, kind of holding up relatively okay relative to what's going on with technology all the way out to real estate and communications. So it's been quite a change. There's much more focus on corporate fundamentals, which is important. So if you listen to an earnings call and they beat analyst expectations and they have a rosy revenue forecast, that company is going to be rewarded. In the past, it didn't matter. It was if you were in the big high flying mega cap tech stocks, you just did okay. It didn't matter really what the fundamentals were at that point in time. But so that's back in play, which it makes a better environment for active management. Active management's underperformed during that whole period for the reasons I spoke about. Now we're seeing active management kind of pick up as we move forward. International equity markets. So again, negative here across the board. Latin America, slightly positive for the quarter. A lot of that had to do with just commodity producing nation. The big news on the international front is China, obviously. Their zero COVID policy really has impacted supply chains globally. And their GDP growth used to be 6 to 8%. Now we're looking at 3 to 4% growth in China, second biggest economy. So it definitely has had an impact to international and emerging markets in the regions. So that's been pretty significant. And the rising dollar has also had some pretty big impact on asset classes like emerging market debt and emerging market equity as well. Fixed income has really been the big news, right? So if you look at the yield curve on the bottom left-hand chart, you could see we had a very low yield environment back in 9/30 of 2021, but it was a pretty healthy yield curve, kind of moving out, sloping upward. Fast forward to today, rates have gone up across the yield curve significantly. And you can see that all the way on the short end of the yield curve, you have 1-year bonds that are higher than 10-year bonds and 15-year bonds and 20-year bonds. So that's part of the reason why we moved a little bit into limited duration more recently, because you're actually clipping a pretty good coupon on those short duration bonds now. Limited duration, I think the coupon's around 4.25% now, where your core fixed income's slightly above that, but we're taking on less duration risk by being, by diversifying into limited a little bit more away from core fixed income. So the Fed came out with 75 basis point rate hike last week. The markets started out pretty happy about that because they thought they heard that there was going to be a pause coming soon. But then Powell came out and started fielding questions, and it was pretty apparent that they were not done yet. So the market reversed entirely and went south pretty quick. So fast forwarding to where we are today, some inflation news came out today, and the inflation numbers, while still high, elevated, were under the what was expected by the market. So that's why you're seeing the markets rally significantly. We're in a scenario here where good news for the economy is typically bad news for the markets, right? So if we see strong unemployment numbers, which are pretty strong, even though unemployment ticked up 0.1%, not a whole lot, the markets tend to sell off on good news because they know that will give the Fed a more hawkish tone and allow them to continue to raise rates. And the market wants rates to pause and stop, the Fed to stop raising those rates. Once we start to see a light at the end of the tunnel, we probably will see the markets rally even more if that does happen. We're still not out of the woods though. We have geopolitical risks worldwide, obviously Russia, Ukraine. We have threats of China invading Taiwan. So all these things combined makes it a pretty difficult environment for investing. And it's why it's important to really kind of hold to your guns and stick to the asset allocation, make some minor tweaks under the hood, which we're doing in some of your active strategies all the time. That makes a lot more sense in this environment because you can really get whipsawed pretty quickly with all this volatility. Any questions around fixed income? Okay, I have good news, bad news. You can use this for your minutes. I pretty much spoke to all this, so we won't spend time there. And as of September 30th, the portfolio was at 124,711,000. I looked at it as of yesterday. It was up to 127,487,435. So that's 127,487,435. Obviously, it doesn't include today's market rally. We'll have to see where we end up at the end of the day today. But again, lots of volatility. I know you'd like to get the most updated numbers, so that's the updated number as of yesterday. So it's been a rough ride. I mean, year to date, net of fees down 21.09%. We've lagged the index slightly there this year. A lot of that can be attributed to just the core fixed income had some short-term underperformance this year as a result of how we were versus the index. It was really a duration story why we underperformed. But everything else, you're mostly indexed across the board. The US equity factor-based allocation, again, it's new. You'll see a number in there for October, but it was new at the end of September. And we already talked about most of the asset allocation, so I'm not going to get into a lot of detail here. And then finally, you have your fixed income and your real estate. You could see the rest of your fixed income. Again, you'll see a return for limited duration and emerging market debt in the October report, or the next meeting, you'll have numbers there. And that's all I had.
Okay.
Thank you, Pat. Appreciate it. Move on to Sageview.
Great,
Um,
I'm gonna take control and share my screen, Pat, if you're,
Yeah, I'm gonna stop sharing here. Hold on one second.
okay.
Okay.
Great, can you see my screen now?
yes.
All right, so many of the pages in this deck are very similar to Patrick's, and I think our view of where we are, although uncertain, is pretty similar. So as you go through some of our economic slides, you'll probably see some similarities, so I'm not gonna spend much time there. Sageview Advisory Group acts as the investment advisor, so we run analytics on the underlying strategies in the portfolio. And we've created a proprietary scoring system, which I'll walk you through. Generally, we think the portfolio is in excellent shape. We'll talk about a couple funds that kind of show up on our radar. Patrick and I have talked about one of the funds in particular, which is a newer fund, and I'll give you an update where we stand there. So similar layout, I think, from economic standpoint. Feel free to kind of go through our charts as if you have some additional time. I'm gonna land on this page, and I know it may be hard for you to see. I'll try to expand it a little bit. Okay. We have a mix of active and passive funds in the plan, which we think makes sense. On our proprietary scoring, we look at 9 criteria, which we think are important for retirement plan investments, as opposed to a retail fund that we may use for more short-term purposes. So we focus on, as you would expect, performance. We look at risk-adjusted performance in a couple different metrics. And then we also look at kind of characteristics which we think are very important: up capture, how well a fund does when their particular category is positive for the quarter, and also down capture, which we're running into a lot this year, obviously, with the market down. And down capture focuses on risk and how much of a loss a particular fund takes in comparison to some of their peer groups. And then we're looking for consistency. So we look at metrics like batting average in rolling 12 months. We take all those statistics and we score each fund versus their peer group to get a ranking. So that's what you see across the top, left to right. And then Sageview's ranking on the far right scores the fund within its peer group. So lower is better. The scores range from 1 being the best, 100 being the worst. So I'll just walk you through the limited duration, which I know is a newer fund and with a more short-term focus. So these 9 scores from left to right show how this particular vehicle scored versus the Morningstar peer group. And for the most part, the fund scores very well. So about 7 out of the 9 criteria come in above 50, below 50 percentile. Lower is better, and that leads to an overall score in the 12th percentile. Okay, so meaning that the SEI limited duration outperforms 88% of the peer group based on our 9 criteria. That make sense?
Yep.
All right. The next 2 fixed income funds on the same par, actually top decile performers, very good performance, low cost, good consistency, and good risk metrics. The emerging market debt's a little bit of an interesting one. It's a smaller peer group, so performance can fluctuate quarter to quarter. Also, with the hedge dollar, depending on the denominations of the underlying holdings, can affect the underlying performance. This is about 50% in U.S. currency denominated, 50% local. All right. My apologies in advance. I'm having a dog issue right now. Excuse me one second. My apologies, sorry, two of them at the same time. So the emerging markets debt portfolio is a small holding. It's about a 3% allocation to the portfolio. So obviously not a major concern there. It's only been in the portfolio a month. We agree with the logic of adding it just to further diversify the fixed income holdings. Patrick and I discussed the portfolio in detail. We're comfortable with how it works. So the fund doesn't score that well overall with SageView's ranking, but we're comfortable at this time having it in the portfolio. And then the last two funds pass our scoring as well. The factor allocation is the portfolio. It's a little bit more tactical. So probably not going to score great on a lot of metrics like R squared, because it's not going to look like the peer group or the benchmark. And then the consistency, because it's going to hope to outperform in certain markets, it's probably not going to score well from a batting average standpoint. Real estate fund, top decile, no concerns with that.
The real estate fund, the expense ratio kind of stands out. What is
Yeah,
that?
it's in the 60th percentile.
I see. Okay. All right. I misinterpreted it, but it was a reflection of the expenses.
Yeah, that's a good observation. These are rankings. So, the way to read these are generally the first 5 funds are cheaper than, more than 90% of their peers. The SEI real estate funds a little bit in the middle of the pack. There's a lot of real estate funds that are passive, so that's going to skew that one way. So kind of middle of the road for the score there. Yep, not the expense ratio. So that's kind of our observations from an oversight standpoint. We think the funds are very strong. We're comfortable with the fact that our scoring doesn't match up perfectly with the emerging markets debt. We'll continue to watch it, report back to you. And then from time to time, we may make a recommendation to, maybe change the allocation or an underlying fund.
Mark, just a question, going back to page 18 for the emerging markets debt, just the very last column, it's kind of in a yellow color. Is that 60 or 66%?
66%.
Okay, thank you.
Yeah. And again, of the peer groups, that's probably one of the smallest. There's only about 200 funds in that peer group. So that's a fund we could be sitting here in a quarter and it's, it's in the 35th percentile just because it had a really strong quarter, which lifted the year-to-date numbers. So it's going to be, that score for this particular fund is going to probably be a little bit more volatile under our metrics.
And that asset class has been extremely volatile with everything going on in Russia and Ukraine. Pat, was there any Russian exposure at all, before the invasion with Russian emerging debt?
No, I mean, there was a very, very small portion of that. I think we went through that several meetings ago. I don't have the exact number, but it was like less than 5 basis points of exposure, and at a portfolio level, essentially 0. So, but we made a decision as a company to divest from all Russian assets back, right sometime after the war started, we did that.
Great. So are any questions on the makeup of the lineup or the analysis that SageView does? This is something we do every quarter, so we'll have new numbers in a very similar format, in the following quarters going forward, as we have in the past. But any questions now?
Not at this time.
Okay. John, can I just walk us through quickly the kind of the asset allocation, story in terms of where we are, what our thoughts are, what our recommendations are?
Sure, please.
Okay. So basically, as I mentioned earlier, we've kind of gone from, a scenario in which we had at one point 7.5% expected return, dropped that to 7.25%, and now have settled at 7%. Kind of the makeup of how we come up with, what a recommendation would be is to look at the what we call the capital market assumptions. Patrick, I think, had shown a page, in his presentation on that. That would include for each asset class what the expected return is for that asset class, what the standard deviation or the volatility is for that asset class, and then how that asset class correlates with the other asset classes that are in the portfolio. And hopefully what you end up with is asset classes that don't have positive one correlation with each other, that there's a diversification reason to include different asset classes in the portfolio. Then you sort of look at it from a time perspective. Are we looking at it from a very short term, 1 year, 3 years, 5 years perspective, or do we take kind of that longer term horizon, which is what typically a pension plan has the ability to do to sort of match up with the liability. So we tend to try to focus as best we can on that longer term perspective. And then what we want to do is we want to get a lot of input in terms of what different companies look at for their capital market assumptions, because very rarely are two companies looking at it exactly the same way. And so we look at the way SageView comes up with capital market assumptions. We certainly look at the way SEI comes up with it, and then we look at the industry, and there's a lot of different ways of gathering that information. And I got to be honest with you, at this point in time, the range of capital market assumptions, particularly the expected returns, are wide. They're greatly variant. And I think that's obviously due to the volatility that we're seeing in the marketplace and the uncertainty that we're seeing in terms of the direction that real or equities and particularly fixed income are going. And so we try to gather and get a best case scenario in terms of where we are. And what we settled on in the past was coming up with the portfolio of the asset classes and the different investments that we have, and looking at that and saying, based on all the capital market assumptions that we come up with, what's a reasonable number, and we came up with that 7%, a little over a year ago. And I think that number is still appropriate. The industry, it seems like 7% is within the range of where many companies are settling at. Some still, I think it was Pat who said it earlier, some still have a higher expected return, 7.25, and they may be on a more aggressive allocation than what the town of Groton is, and some have kind of trended towards something south of 7%. And I don't think it's time to do that at this point in time. What we're seeing is some of the individual asset classes actually have ticked up a little bit over the last year. So we're starting to see a reversal of that trend where everything was coming down, and certainly fixed income looks like it's ticking up, over the short, intermediate, and longer term. So I think it's important to kind of stay where we are at this point. We just made the asset allocation changes to the portfolio. Let's take as suggested earlier, let's take a hard look at this in maybe the second quarter of 2023, and see, as the markets hopefully have settled down a little bit, where those allocation numbers will be, and the capital markets will be as well. So our recommendation would be stay the course at this point, with the 7%, let the actuary kind of run with that. And while we're likely going to see losses on the asset side from the expected returns this year, certainly as expectations will be, that's likely going to reverse itself, in the sometime in 2023 as the markets kind of reverse course. At least that's our expectation. Questions?
Thank you, Ken.
Okay, my pleasure.
On to the regular meeting schedule. Hopefully everyone has time to look at that, keeps it as it is. So I'd entertain a motion if people are good with it.
Second.
Is that you? I missed, was that you, Jen? Okay. Got it. Okay, we have a first and a second. Any discussion? If not, all in favor, say aye.
I,
Opposed, same sign. Carries unanimously. And I'll look into, getting that overview scheduled, pretty quick in the new year. So we'll start looking at that. No longer meeting to have them come in and review things.
So, I just keep thinking of questions that I have. A lot of organizations that have some sort of longevity have different classes of people on different pensions because there have been changes in their pensions over the past 20 or 30 years. And so it'd be helpful just to even understand what the current plans are and if there's a mix of people in different programs, liabilities, just sort of a real 101 on what it is that provided. That would be helpful.
Okay.
That actuarial assessment may
Well, it'll probably
provide
have
some
some information on
information by union and so forth, because we're all different.
I would find that extremely helpful too, because it's my understanding our fiduciary responsibility is to the folks in the plan.
Right, correct.
Not, and I don't want to sound disruptive. It's not to the town, to the plan.
Yeah.
However,
But it's
they go hand in hand.
absolutely.
So, I mean, we had a lot of discussions at the state about our fiduciary responsibility. For instance, when we got out of the Sudan, we dumped guns. Some would say that's not following your fiduciary responsibility, but as a social justice issue, it became an issue. But I'd like to know the number of employees and I realize there's different bargaining units, but what they're paying into the plan. And I'm comfortable with the 7%. I would have a hard time changing that at this point. Obviously, it's going to be a tough year or two, but 7% is not outrageous. Because if you raise it, it helps one group. If you lower it, it helps different. So we played that game at the state level.
Well, all that information, is documented in a bill. We have any of us as citizens couldn't suggest things to the council and ultimately the RTM, but our role is not to say, hey, that 4% contribution should be 5%. We may feel that. But that's really not our job to get involved. But we need to, we all need to know.
Yeah.
Yep.
So some of the structural questions would be helpful. How many employees, what each bargaining unit is paying for that versus what the taxpayer is picking up, just gives you a better sense of a responsibility to the fund. Even going from 124 million to 127 makes a huge difference in this fund. Whereas, at the state, it was a $27 billion fund 10 years ago when I left. So if it chirped $500 million, no one was losing their mind. But we had a much larger cushion. But again, we made it through the recession. And right now, everybody's trying to play with the supply and demand issues, the pent up amount of savings that everybody was trying to get rid of. Then there wasn't product to buy. You throw in what's going on in China. There's a lot of jitters right now over what they may do. And the stock market is an emotional beast. So I think it's well positioned. I like the fact that plan is as conservative as it is. It's certainly not overly aggressive.
There will be, and I think it's readily available online. There is a fairly, I think we still do it, John, lengthy discussion in the town budget about the contribution, how the contribution that the town is obligated to make every year is determined. And so there's a lot of, both of you gentlemen seem like you know quite a bit about investing. So it will probably, for some of us initially, it was all Greek, but I think it's still in the contribution section of the budget.
And I'll get that to you.
Okay, thank you.
There's nothing, first of all, Ken, congratulations again. It's been great working with you and we look
Thank
forward to working with the marks. But,
Thank you,
but,
John.
we do thank you for everything you've done and wish you well.
I appreciate that. It's been great working with you guys. I wish I had more time with the newer members, but you guys are in great hands with the two marks. So thank you. Appreciate it.
Thank you.
Ken, any travel plans initially or?
Maybe a little bit down to Florida. We got my mom's down there, so kind of go see her, and assuming that Florida still exists after the hurricanes they've had. So, but I think my wife wants to go to Europe. Maybe the strong dollar is a good time to do that. So, yeah, she's got a lot of plans for me to fix up the house. So.
Been there and doing that.
Exactly. Thanks, guys. Appreciate it.
Thank you. I'll entertain a motion to adjourn.
So move. This is Mark.
Second, Michael Freeman.
We have a first and a second. Any discussion? If not, all in favor, say aye.
Aye.
Aye. Opposed, same sign. Motion carries unanimously. Thank you, everyone, and happy holidays.
Yeah.
I can't believe we're at here.
Have a great holiday, everybody.
Nice to meet everybody.
Happy holidays.
Take care. Good luck, Ken.
Thank you. Take care.
Thank you.